Looking across the rapidly expanding Nairobi skyline, a parallel boom is taking place entirely online. Across Kenya's urban centers, retail Forex trading has exploded into a massive digital industry. The appeal is straightforward. Everyday people are logging on to tap into the daily movements of global currencies, looking for a reliable way to grow their personal wealth from their smartphones. But a gold rush of this scale creates a vacuum. It attracts offshore predators who set up shop in unregulated corners of the internet, specifically targeting eager new traders with predatory terms. They cast their lines with very specific bait, unbelievable leverage ratios that multiply risk, massive sign-up bonuses, and instant account approvals that skip basic security checks. Market volatility is a standard trading risk, but it pales in comparison to an ecosystem engineered to drain your account before you even place a trade. It starts with a calculated trust-building phase. You deposit a small amount, maybe $200. The broker lets you make a few winning trades. They even process a quick $50 withdrawal without a hitch to prove they're reliable. Then the escalation begins. An account manager calls you directly. They apply intense psychological pressure, pushing you to deposit $5,000 or $10,000 to unlock guaranteed VIP signals or a foolproof profit strategy. This animated flowchart maps exactly what happens next. The moment your large deposit hits that offshore node, it's locked. The price feeds on your screen suddenly spike to trigger your stop losses. Your account freezes, and every withdrawal request is rejected. Because the company operates out of a remote jurisdiction, you are met with a wall of silence or endless demands for more verification documents. You have absolutely no legal recourse in Kenya. These losses stem from a calculated theft, not a lack of market insight. Without a regulator, the trader is left without any means of recovering stolen capital. To stop this cycle, Kenya relies on the Capital Markets Authority, or CMA. Backed by an act of parliament, the CMA acts as the official referee of the financial markets, operating with a clear mandate to vet, license, and supervise brokers. This diagram illustrates their most powerful mathematical weapon against fraud, the segregated account rule. Depositing with a CMA-licensed broker, your money legally bypasses the broker's operational budget, entering an isolated client vault. Watch the operational budget crumble. Because your funds are legally segregated from the broker's risks, they cannot pay creditors, ensuring safe return to you. The CMA also forces brokers to hold millions of shillings in reserve capital to absorb unexpected market shocks, and forces them into a formal local dispute resolution process if a conflict arises. These rules create a physical separation between your money and the broker's institutional risks. This structural firewall is the primary defense for any retail investor in Kenya. Any offshore scam can slap a "Regulated in Kenya" banner on their website. Taking a broker at their word is the most common and most expensive mistake a new trader makes. This interface mockup highlights the exact verification step you must take. You navigate directly to the official CMA website and open the public register. You are looking specifically for a license categorized as a non-dealing online foreign exchange broker. From there, you rigorously cross-reference the details. The legal company name and the specific license number on the broker's website must match the official government register down to the letter. If there is a single discrepancy, walk away. A broker might boast about a license from a small island nation in the Caribbean or the South Pacific. While technically a license, that offshore regulator holds zero jurisdiction over a citizen operating within Kenya and has no power to recover your funds. True financial security doesn't rely on trust. By independently verifying that register, you turn your own due diligence into your strongest offensive weapon. Once you verify a broker, you enter a highly secure legal ecosystem. Your very first step will be passing a mandatory Know Your Customer, or KYC, identity check, requiring your national ID and proof of address. While it takes a few extra minutes, this friction is a positive sign of a legitimate operation. It proves the broker is actively complying with strict anti-money laundering laws and actually cares who is on their platform. As you can see on this screen, trading locally unlocks immediate logistical advantages. Regulated brokers integrate directly with platforms like M-Pesa and local Kenyan bank transfers, allowing for instant account funding and frictionless profit withdrawals. If you were tied to an unregulated offshore broker, you'd be forced to rely on international wire transfers. Those take days to clear, carry high intermediary fees, and are highly vulnerable to being frozen by compliance departments. Operating locally also brings legal clarity. Forex profits are considered taxable income in Kenya. You are obligated to maintain accurate logs of your trades, deposits, and withdrawals to declare your net gains accurately to the KRA. Meeting your tax obligations and passing KYC protocols strips away the precarious nature of offshore gambling, elevating your trading into a completely legitimate, scalable business practice. The Kenyan retail market offers immediate access to massive global liquidity, but those opportunities only materialize if you strictly confine your operations to the CMA's protective framework. The sequence for personal safety is non-negotiable. Before risking a single shilling, verify their license on the public register. Then, open a demo account and test their platform stability for yourself. A fully licensed, compliant broker like FXNX provides that necessary infrastructure, offering the regulatory guarantees required to trade with absolute confidence. Long-term success depends entirely on capital preservation. Making verification your first step protects your investment from fraud, which is the most significant risk in the Kenyan market.